Hey there, if you're watching this video, it's because you've purchased my simple STR calculator, a spreadsheet and template that's going to help you analyze short-term rental investments quickly and effectively and as simply as possible so that the average person can plug in and use it without getting overwhelmed. At the time of this video, I'm working on a much more robust and complex calculator for maybe more advanced folks or people that are a touch more analytical than even I am. And that should be uploaded into wherever you purchased the simple short-term rental calculator. That should be uploaded there soon. So if that is your jam, if that's your style, feel free to check that one out too. But I have gotten this far with this simple calculator. I've purchased multiple short-term rentals this way, as have friends and family and clients using this tool. So it is sufficient, and it is a great tool to figure out if a property is going to cash flow and provide cash on cash return. So that's the core metric in the spreadsheet, is taking your initial cash investment and looking at the annual return or profit into your bank account divided by the initial cash outlay. So let's say you put $50,000 into purchasing a short-term rental. You would want, in order to get a 10% cash on cash return, you would want $5,000 of cash pre-tax cash flow. So after all expenses, $5,000 coming into your bank account at the end of the year. And that would be a very successful short-term rental. If you think about what sort of returns you can get in other assets, in savings, in stocks, bonds, crypto, wherever it might be, to be able to buy an asset that you expect to appreciate over the long term, provide tax benefits, principal pay down, and then also provide you a 10% cash flow into your bank account. That's an incredible opportunity and asset. So that's 10% is a number that a lot of people throw around. I like 10%. I think the right profile of investor could be very excited about 2% or 5% if they're optimizing for putting cash in an asset that diversifies them away from stocks or crypto, or gets cash out of their 0% savings account and into an asset that they believe in long term, and or if they believe in the market long term and its ability to appreciate. So that's kind of how I think about cash on cash return. I think for a lot of new investors, you're targeting at least like 5% cash on cash return, 5 to 10%. And the higher you are, the more cushion you have for market turns or errors in your estimations and cash flow and expenses, et cetera. So that's a lot of kind of the high level theory around what this calculator is telling you. And I digress a little bit. So I'm going to plug into a scenario, an example of plugging in a property into the calculator and walking you through each step of the calculator so that you can use it effectively and start plugging in and evaluating properties yourself. So I find a property on the MLS or on Zillow that looks interesting to me. I like this particular property because it's got a lot of value add potential and has some desirability and attraction for guests. We've got a pond, we've got a pool. Not sure how nice that pool actually is, but it looks cool. This property's got a lot of potential. It's probably priced lower than, I know for a fact it's priced much lower than most other 4 or 5 bedrooms in this market because it needs some updating and it needs to be modernized, and cabinified is a word I use a lot, and brought to Airbnb standard, right? Instagram standard, but a lot of potential, big lot, cool property. So I find a property I like. I'm going to first, before I spend any time analyzing it, I'm going to plug it into 2 tools, data.rabu and the AirDNA Rentalizer tool. You can Google search AirDNA Rentalizer, or you can go to biggerpockets.com, tools, Airbnb, and plug it in real quick. I like this way because it's just quick and easy. I don't have to log in to anything really. And then I'm going to get 2 data points that are going to kind of give me that go, no go right out the gate. So this is spitting out 87,000. Quick note on AirDNA Rentalizer is it from what I understand, it includes cleaning fees in your gross. And so you kind of want to take those out and adjust this down by 10 to 15%, depending on what you roughly estimate cleaning fees are in a market. In general, I think 10 to 15% is safe. So bring this down to mid 70s, for example. And then data.rabu, you're taking that monthly number, extrapolated over 12 months average. So you're looking at 50, what is that, 60, 65,000. I try not to do public math, but I just did. So 65 to 75K. So that's going to come in handy when we go to this section of the spreadsheet and we come up with our annual rental income number, which, as you can see, I've got that kind of on the low end of that range that I just came up with based on these tools. And before I even went there, I determined that this property was worth analyzing at a purchase price of 600. My revenue projection is somewhere in the, I like to look at annual revenue projection divided by purchase price. And I want it to, at a very minimum, be 10%. 10 to 15% is worth analyzing. 15 to 20% is very likely going to be a great property, and anything above 20% is likely going to be a home run. This one's on the lower end of the range, but in this market, it's hard to find stuff that's not, especially on market. And so I also think that if I could bring this one up to like the 75th percentile, I know that my my marketing capabilities are worthy of a 75%, top 75% performer, rather top 25% performer. And so if I can get the property up to those standards, I can get 6,500 a month, which again, extrapolated out. I'm going to calculate that really quick. 6,500 a month times 12 is 78,000. Combine that with the AirDNA, maybe I'm looking at more like 75, 80,000, and 75, 80,000. Let's do 78 over 600,000 is 13%. So again, still kind of tight. But I think this one is worth considering and worth looking at. It has some potential for the right investor. So let's assume that at 600,000, we just think it's too tight, but this sits for a week or two, which is happening at the time of this recording, stuff sitting a little bit. And I plug in a purchase price of 585. So this is kind of one of the big input cells that we're going to be editing, right? The purchase price. The yellow cells are input cells. These are the cells that we change. The white cells are going to output numbers based on what we put in the yellow cells. I like to plug in the address and overview details. You can use this sheet to share with partners. So there are some partner estimates around cash investment, profit for partners, and cash on cash return per partner. And so, sorry, I had a little bit of a lull there. And so once we plug in those details, I like to link the property here if I'm sharing this with a partner. Then we're going to go through and kind of analyze. We get to determine what our target cash flow is, what our rent to value ratio is as far as our purchase price and cash flow goes. And then we're going to plug in the purchase price. When we play around with this, let's say they have a big price drop because they get no activity for the first couple of weeks. They drop it to 550. That's going to change our mortgage payment, and we can also play around with the interest rate. So if you're analyzing this property and you check in with your lender and they say that the rate you're probably looking at is around 5.5 if we locked this week, then you can play around with that. Annual tax, this is about right for this property. There's no HOA on the property, and the utilities, this is probably about right, 300 to 400. And then we can play around with the down payment. So we've got kind of our cost section here. So we're playing with our costs. On a 1990 build, we probably want to have slightly higher CapEx than a newer build, right? So I went a little high on the CapEx here, but depending on how much initial money we put into furnishing and remodel, this might be lower, right? So maybe it's 200. We have a good inspection and we see that the property is actually in really great shape. Maybe we're only setting aside 200 because we've also got some initial reserves, right? So we're playing around with our down payment. That's going to move our mortgage payment around depending on what we do. 10% second home loan is an option. 15 to 20% is common for investment products. You can check out DSCR loans as well. On this property, we're going to need a higher furnishing and remodel budget. Maybe we're scrappy and frugal and we go 20K, but I don't know that that's really realistic on this property. I think you should be safe in your remodel projections, a little bit conservative because everything costs more and takes longer than you think. And we're going to have some initial reserves set aside. And because this property has been sitting, we're going to get closing costs covered. So we reduce our out-of-pocket expenses up front. Now, that's kind of our financing cash out of pocket section of the spreadsheet. And here we have our income section of the spreadsheet. Now, based on the average daily rates I'm seeing here and the occupancy, I went quite a bit lower on the daily rate and quite a bit higher on the occupancy, which is kind of my preference. I like to have a semi-full calendar and I like to get more reviews and more bookings and more reps, and have happy guests paying a little bit lower for the same experience. So either way, you can play around with these two numbers, which is what you're going to do, and you're going to get an annual number, right? And this is right in that kind of range that we initially forecasted, which gives us an $11,000 annual profit, which is probably too high, frankly, after kind of, I played around with a few things here. We've got the sample price at 50K under asking price. So if we were to raise that to 600, it would bring our profit down quite a bit. But again, not bad. I think there are some things that are realistic in here and some that maybe aren't as we went through it together. But this is a property that is projected to have a total of $8,000 in profit after all expenses. And if you're splitting that with a partner, that's $400 a month with a total cash on cash return of 5%. And depending on how you structure the partnership, you could have higher percentages for individual partners, right? If you've got like an equity partner versus a managing partner with less cash in the deal. So different scenarios to play around with over here. And again, I think cash on cash return is just one metric. So that's why I call this a simple calculator, because a lot of people are looking to buy real estate to increase their cash flow. But you also need to consider that there are many wealth generating tools in real estate. And so for some people, 5% might be amazing, perfect, a total home run. And for others, it's not enough. And I tend to, in my early investing careers, skew towards targeting higher cash on cash returns than maybe what we're seeing here. But over time, as the market shifts, you have to adjust your strategy and figure out what your goals are and if that can work, right? So that's a sample scenario of how I run through the calculator. You are free to evolve this sheet, add to it, change it, add additional metrics like return on equity or IRR. And there are lots of ways to evaluate this deal, taking into account things like depreciation, tax benefits, principal pay down, looking at how the loan is amortizing, and sample estimates of appreciation depending on the market you're in, right? So I hope you enjoy this sheet. I hope it's helpful in evaluating properties. And like I mentioned, I have a more robust spreadsheet coming if it's not up at the time you're watching this video. So look out for that if this isn't doing it for you. But like I said, this has helped me buy 4 short-term rentals now myself, and my brothers have several as well. And I've shared this sheet with clients and friends who have had a lot of success with it and said it's been really helpful in their journey. So I hope it helps you in yours.